Over the last few years, we have seen around 10 times more HMRC inquiry letters than we used to. And I'm not talking about billionaires with offshore structures. I'm talking about ordinary businesses like sole traders, small landlords, side hustlers selling on eBay, Vinted, people taking payments through PayPal or Stripe, small limited company directors with messy records. Most of them are not dodgers. They are people who made a mistake or whose numbers simply don't match what HMRC can see. And that is the key point. Because in 2026, HMRC doesn't need a tip-off anymore. They have got data. So in this video, I'm going to break down the main reasons HMRC investigates, the red flags that trigger it, and what to do if you get the letter. So you will pay only what you actually owe. And don't forget to subscribe. These videos are free and can help you avoid costly admin mistakes. Why this is happening now? HMRC has invested heavily in tech, especially a system referred to as Connect. Connect cross-checks data from multiple sources and looks for mismatches, income, spending, and assets patterns. And at the same time, there are new pipelines feeding HMRC more information, including platform reporting. If you sell goods online, there is a reporting framework where platforms may report seller data when sales exceed certain levels. And then we have got making tax digital for income tax, rolling in from 6th April 2026 for people over £50,000 qualifying income, which means more submissions, more deadlines, more chances for inconsistencies. So the big picture is this. HMRC are not guessing anymore. They are cross-checking. And when your story is not consistent, you get flagged. The core idea, the mismatch rule. Here is the rule that explains most investigations. HMRC investigations usually start when something doesn't match, not when someone is proven guilty. A mismatch can be money hitting accounts that doesn't align to declared income, VAT patterns that suddenly change expenses that look unrealistic for your trade, repeated late filings, platform income that exists but is not reflected in a return. So let's break down the biggest triggers. Number 1, unexplained bank deposits, personal account chaos. This is a big one. If money enters your account and it doesn't match what you have declared, you can be flagged. And it is not always income. It could be a family gift, a loan repayment, a refund, selling personal items, transferring money between accounts. But to HMRC, money lending with no clear explanation looks like undeclared income. Quick example. Let's say you declare £55,000 taxable income, but across personal bank plus PayPal plus platform, there is £75,000 coming in. That doesn't prove wrongdoing, but it creates the question, what is the extra £20,000? And if your records are messy, you can't evidence it quickly, and that is how it escalates. How to fix it? Separate your finances. If you are self-employed, get a proper business account. If you are limited, stop treating the company account like your personal wallet. HMRC loves boring things. Make your finances smart, not boring. Number 2, platform reporting plus it is only a bit income. This is where people get caught out. They think it is only a few sales, it is only a side hustle, it is only a pocket money. But platforms increasingly share seller information with HMRC under digital platform reporting rules, with reporting tied to activity thresholds. Again, visibility is not the same as text due, but it often triggers questions like someone sells personal items on eBay, then starts buying bundles to resell. They still tell HMRC it's just personal items. That single sentence can move you from casual disposal to trading territory, and no, HMRC may widen the scope. How to fix it? Know your story, evidence your story, and don't guess. Number 3, expenses that look too good. Everyone wants to be tax efficient. I talk about it all the time, but HMRC can benchmark. If your expenses are unusually high for your income and trade, you stand out. You are a consultant earning £72,000, claiming £46,000 expenses every year. HMRC's first thought isn't it drama? It is a maths. How are you living on what's left? And then they ask for invoices, receipts, mileage logs, business purpose evidence. If you can't prove wholly and exclusively, they disallow costs, tax increases, interest plus penalties. How to fix it? No receipt, no claim. Keep mileage logs. Sanity check big categories like travel, home office, subsistence. Don't round up numbers. Keep your records clean and consistent. Number 4, cash heavy trading plus weak records. Cash is not illegal, but it is harder to trace, which means HMRC scrutinizes it harder. Sectors on hit list: hospitality, barbers, beauty, trades, and market stalls. What HMRC do is compare your turnover against signals like supplier invoices, card machine trends, staff levels, opening hours, utilities, stock purchases. If your costs suggest high activity but sales look low, it appears like suppression, even if the truth is just poor admin. How to fix it? Reconcile stock takings daily. Cash book, keep stock and sales aligned. Number 5, VAT patterns that break the normal. VAT is often the opener. HMRC love patterns, repeated late VAT returns, lots of nil returns, frequent VAT reclaims that don't match the business profile, sudden turnover drops that don't match other signals. Two businesses that look like one, risk of disaggregation and backdated registration. How to fix it? File on time, keep VAT logic consistent, and don't run two separate businesses through one brand. Number 6, late filing of returns. Risk scoring. One late return happens, but patterns matter. Repeated lateness, amended returns, profiles swinging wildly with no explanation, inconsistent income profiles. Even if there is no fraud, it raises a risk score. How to fix it? Systemize your compliance, calendar reminders, bookkeeping routines, monthly check-ins. Number 7, lifestyle mismatch, what you show versus what you declare. This is the one people laugh at until it bites. If your lifestyle visibly looks bigger than your declared income, HMRC assumes there is money coming from somewhere. Sometimes it is legate, inheritance, a one-off asset sale, gambling winnings, partner income. But if you can't evidence it clearly, the default assumption becomes taxable income. How to fix it? Keep documentation for big inflows, gift letters, loan agreements, sale evidence, inheritance paperwork, completion statements, brown envelope playbook. What to do to fix it? First, now let's say you have got the letter. What you need to do? Number 1, don't panic and don't call HMRC in a rush. People panic, call and start explaining. Calls can be recorded. One innocent slip can widen the scope. Number 2, identify the letter type. Is it a nudge letter or it's a formal inquiry assessment tone? We think you owe us a money, prove us wrong. Approach differs, but the rule stays the same. Number 3, don't ignore it. Ignoring turns small issues into expensive ones. Interest, penalties, and escalation. Number 4, assess your position honestly. Do you know what it relates to? Do you have records? Can you evidence your story? If your records are solid, you might handle it yourself. If you have gaps, missing statements, unclear trading versus personal sales, unclear expense rules, get help. Because if you can't evidence your position, HMRC will default to an estimate, and HMRC estimates are generous. What happens when you engage the process? Typically, number 1, you acknowledge and cooperate, not an admission. Number 2, they request documents like bank statements, receipts, platform histories. Number 3, you submit evidence in an organized narrative. Number 4, back and forth questions. Number 5, settlement of tax actually due versus estimates. Number 6, penalties can reduce based on behavior and cooperation. Number 7, if you can't pay, you can negotiate payment terms, time to pay. The goal is not to avoid tax. The goal is to avoid paying more than you owe because you handle it badly. So here is the recap. HMRC investigations usually start because something doesn't match. The biggest triggers are unexplained bank deposits, platform income not reflected properly, unrealistic expense patterns, cash-heavy trading with weak records, VAT patterns breaking consistency, repeated late inconsistent returns, lifestyle mismatch without evidence. If you have got a letter, don't panic, don't ignore, don't guess. Get organized, build your evidence, respond cleanly. If you have received a letter and you are not sure how serious it is, contact us or drop a comment with the journal situation, no personal details, and I will point you in the right direction.